Good afternoon, everyone, and welcome to our first quarter 2025 Market Insights webinar. Now, normally we would just share our thoughts and feelings on markets through the first quarter of 2025, but to say the first half of April has been tumultuous would probably be an understatement. So we're also going to share thoughts, commentary, and some information on what's happened the first half of this month and what that means for the remainder of the year. Now, before jumping into the content of this afternoon's webinar, the normal housekeeping items. If you would like to submit a question, please do so using the Q&A feature. I will tell you that we have just about an hour's worth of material prepared for the webinar this afternoon, but if we do not answer your question live on air today, we will respond back to you off air to answer your questions. This will be recorded and uploaded to our YouTube channel, so as you are so moved, please feel free to share with colleagues. Introductions. My name is Greg Leonberger. I am the Director of Research here. I am the traditional host of this webinar. I also cover the U.S. economy section this afternoon. Joining me today are our lead asset class analysts, Frank Valley for fixed income, Catherine Hillier for U.S. equities, David Hernandez for non-U.S. equities, and then for the alternatives portion of this afternoon's session, Evan Frazier will review hedge funds, Dennis Yu will cover both real estate and infrastructure, and Haley McCollum and Chad Schaefer will review private equity and private credit. Now we'll kick this off talking about the U.S. economy. I think everyone here is aware of what happened on April 2nd, proclaimed as Liberation Day. Widespread tariffs were announced, impacting every country that we do trade with. The depth and magnitude of these tariffs were greater than expected, and as such, we've seen a lot of volatility, tremendous ups and downs, massive swings in markets between fixed income and equities. We'll get into all those markets in greater detail in just a couple of minutes. Of course, this has cast a bit of a greater cloud of uncertainty over markets, with questions mounting about growth, recession, inflation. However, it's worth noting that overall policy about the economy, or uncertainty about the economy, as measured by the U.S. Economic Policy Uncertainty Index, has really spiked since Trump's election. Of course, everyone was aware that tariffs were going to be implemented. However, the absolute level of tariffs was not completely understood going into Liberation Day. That explains at least somewhat what we've seen in markets. And it's not just a policy uncertainty index, but if we look at other measures of economic sentiment or expectations, we can look at consumer sentiment shown by the gray bar in this graph, or inflation expectations shown by green. And those really kind of been moving in the wrong direction. As sentiment has dropped, inflation expectations have increased. And on top of that, probably not surprisingly, the odds of recession have also ticked up. Now this is not an absolute call for stagflation, which is a combination of a recession and high inflation and likely high rates as well. This is not a call for that. However, expectations of slower, if not negative economic growth are higher today than they were a couple of months ago. And this is something that really bears watching, as it'll have a significant impact on financial markets. And to touch upon kind of the shorter term reaction of markets relating to the tariff announcements on April 2nd, what we saw, and I'm sure everyone is well aware of, U.S. equity markets were really volatile, as has fixed income. And critically, what you normally see in times of market stress when equities are selling off is that treasury yields tend to drop, meaning treasury prices go up. The two asset classes have traditionally been inversely correlated, but we actually saw over the last 10 to 14 days is really a rising correlation between these two asset classes. So not only were the equity markets selling off, but bond markets were selling off as well, which made things even more confusing for investors. So we'll touch upon all these, and I think it's actually a pretty easy transition to move the movement of equities and fixed income into the actual asset class section. So Frank, we'll hand it over to you for fixed income to talk a little bit about what you're seeing shorter term, as well as what you're watching for in the coming months.
Thanks, Greg. So fixed income performance was solid during the first quarter. Lower treasury rates were a tailwind for fixed income markets. The ag was up 2.8%, and the less rate sensitive sectors were up less. So high yield was up about 1% and loans about 60 basis points. This flipped after the tariff announcements. Treasuries initially provided some protection and rallied as equities sold off. However, this reversed and bonds started trading like risk assets and sold off with equities. They have since, however, rallied the past few days. The ag has had some pretty wild swings over the month of April. So year-to-date performance peaked on April 4th at 3.7%. That then faded back to 1.1% on April 11th, and that has since reversed again and rallied back to 1.9% as of yesterday. The long end of the curve has been hit particularly hard, with the long bonds down 3+%. Wider spreads have also put pressure on the credit sectors, mainly high yield and longs. The credit curve, the treasury curve has shifted during the first quarter. It really shifted down across the curve, with the front end falling as anticipated Fed cuts were coming as of mid-year, and the back end pushed down as treasury demand increased as fears in the market rose. In the second quarter, this changed a little bit. So the front end still remains anchored with Fed cut expectations. However, the back end rally has since faded based on inflation and also some strong market technicals, as there has been heavy overseas selling. When we look at the curve is now positive once again, and it is as steep as it's been since early 2022. Yield and fixed income remain attractive. They did move lower in Q1 as there was good performance in fixed income markets, but they have since backed up here in April. The income that's being provided by the index is a good cushion against adverse moves in either rates or spreads. The spread markets have been trading at historic tights, but they have widened here year to date. Spreads are starting to get to the level where they are interesting and maybe a possible investment, but yet they're not anywhere near cheap. When we look at forward return possibilities for fixed income returns still look to be good. So the aggregate year yield to worst is currently right around 5%. So if nothing happens over the next year, you should expect a return of about 5%. However, things do happen. Treasuries rally or fade, spreads get wider or narrower, but that higher starting yield should provide some cushion. You need to see 100 basis point increase in rates or in spreads to see a negative total return. But there is some good news. Generally, those two factors do have some diversification. So it would be unlikely to see a 100 basis point move one way or the other without some offset in the other market. Looking at fundamentals, default outlook for credit remains low. So much of the 2020s, the defaults have been low and below long-term averages. That's because fundamentals have been strong. We expect fundamentals to remain strong in credit, and defaults are going to remain near or below long-term averages. So what are the opportunities and risks in fixed income? We'll start first with the opportunities. The first opportunity is bonds are still back. Higher yields should equate to stronger returns, and the income cushion provides positive total returns in most scenarios. The second opportunity is that spreads are starting to show some signs of life. Spreads have been trading at historic tights, but the recent volatility is starting to show some opportunities, but these are by no means cheap. The risks that are in the market, the first risk is going to be stagflation. That's that high inflation, low growth environment. The Fed will be in a conundrum in that situation. Do they need to cut rates to combat growth? Do they need to increase rates to offset inflation? We think in that kind of environment, rates and spreads are both going to be higher. The second one's going to be stress in the credit environment. So as mentioned, valuations are not by any means cheap. If we do see some sort of a recession happen, you could see spreads widen significantly from where they are today. And the final risk is bonds are starting to trade like risk assets again. So during the inflationary period of 2022, rates and risk were very highly correlated. More recently, bonds started to provide that protection that you know and love bonds for, and that's when risk sells off, bonds generally rally. Unfortunately, over the last few weeks, bonds are starting to trade like risk assets again.
Thanks, Frank. And some messages, this is consistent with what we've shared on previous webinars, that the absolute level of yields and bonds is still compelling. But the volatility within the market and certainly the divergence from historical long-term correlation behaviors is something to watch on a go-forward basis. All right, Catherine, U.S. equities, volatility has been the word that really describes the asset class the last couple of weeks. So again, similar to the questions I asked Frank, curious to hear your thoughts on not only what happened first quarter, but really spending some time on the first few weeks here in April and what to watch for going forward.
Yeah, of course. So before we discuss what has occurred in the US equity market in April, let's touch on the first quarter of 2025. In the first quarter, we saw a reversal from the trend that was evident for much of the past 2 years, as value posted one of its strongest quarters historically relative to growth equities, with the Russell 1000 value the only US equity index to advance in the first quarter, as the Russell 1000 growth fell 10%. Small cap equities also continued to struggle relative to their large cap peers as the Russell 2000 fell another 8%. To preface what David will discuss in the international equity section, the S&P 500 also posted its worst quarter of underperformance relative to non-U.S. equities since 1988. Interestingly, though, it wasn't all bad news in the first quarter, as strong early momentum drove the S&P 500 to new highs in February. But as the quarter closed in March, tariff shocks, soft economic data, and fears of recession began to weigh on U.S. equity markets. This carried over into April as the Russell 2000 and the NASDAQ both fell into correction territory early in the month. As we can see here, all U.S. equity indices posted negative returns through the first 14 days of April. Now, from a sector perspective, the trends from the first quarter reversed sharply in April, as energy has been the worst performing sector thus far, following a sharp decline in the price of oil, while the technology, consumer discretionary, and communication services sectors, which largely house the Magnificent Seven, have fared better following a sell-off in those companies in the first quarter. Notably, the defensive sectors, namely utilities and consumer staples, have fared well both in the first quarter and in April so far. Although equity markets have declined sharply to start 2025, it has not been a linear path, as we can see here. Some of these dates have been mentioned already, but on this slide, we will highlight some of the key events over the first 3.5 months of the year, a period that has seen the narrative around tariffs really drive market moves. As you can see in February, despite Trump already signaling his intention to increase tariffs on key trading partners, the S&P 500 did hit that all-time high on February 19th. Sentiment waned pretty quickly, though, as markets started to decline on tariff uncertainty and fears of recession. Still, it wasn't until Liberation Day on April 2nd that the market saw a really sharp decline. The S&P 500 fell over 10% over the next 2 trading days, while the Russell 2000 and the NASDAQ fell into bear market territory. As market volatility spiked on April 9th, Trump announced a 90-day pause in tariffs for most trading partners, which saw the S&P 500 then post one of its best days on record as it advanced over 9% in that day alone. This highlights the wild ride tariff headlines truly have created for investors. Now, breaking down the more recent performance a little bit further, the VIX spiked above 50 on April 8th, a level not seen outside of the pandemic and the global financial crisis. While volatility has normalized in the past few days, it still remains above long-term averages. But what has driven the S&P 500 returns this year? Entering the year, the Magnificent Seven had been the key driver of index returns. In times of stress, investors even appeared to view these companies as a safe haven given their superior earnings growth last year and the year before. But as we have mentioned in past webinars, risks emerged as valuations began to price minimal room for error for these companies. In a period of elevated volatility, as we've seen, those stocks trading at rich valuations tend to be the hardest hit as multiples contract. The Magnificent Seven was not immune to start the year and have underperformed the broader U.S. equity market as investors have sought safety in gold. Notably, while rich valuations may be part of the story, larger cap companies, including the Magnificent Seven, are also more exposed to tariff uncertainty as these companies generate a larger portion of their revenues overseas. So this segment of the market may continue to see more pressure as a result of tariff announcements. Given the drawdown in equity markets to start the year, the next 2 slides will illustrate the historical precedent for market returns post periods of significant drawdowns, which have generally been positive. On this slide, we see that the 1-year forward return for the S&P 500 following a 15% drawdown has been positive 82% of the time, with an average 1-year return of 12%. This suggests that lower valuations during these periods of market stress may provide some margin of safety for investors. To put this in context to today, the S&P 500 was over 15% off its February all-time high for 3 days in April. Here we break down both severe periods of market stress alongside the best days in the market to see what those forward returns may look like, which are again generally positive. You may notice that these periods in the market tend to be concentrated around major events like the tech bubble, the global financial crisis, or the pandemic. So the worst days in the market are typically closely coupled by the best days. The chart on the left highlights 6 periods when the market declined more than 10% over a 3-day period, which we saw in April. Following that event, historically, the forward 1-year returns have been positive. The more near-term returns have still been subject to some volatility. The same pattern holds when you consider the 20 best days in the market. As the best days largely coincide with the same periods of time where you've seen the largest drawdowns, and the forward 1-year returns are generally positive as we've shown, it makes timing the market incredibly difficult. As we've discussed in the past, the U.S. equity market has been perceived as expensive for quite some time, with valuations sitting at historic highs. This made the U.S. equity market more susceptible to the recent volatility. While the market correction that saw the forward price to earnings multiple fall recently, it still remains above long-term averages. So arguably, while the U.S. equity market is no longer as expensive as it was end of the year, it is still expensive by historical standards. And breaking down the return for the S&P 500, we can see that multiple expansion has supported a large portion of the index return. But this can't be the whole story, as earnings growth has to be present for equity markets to continue to perform well. As multiples contracted in the first quarter and we begin first quarter earnings season, companies will need to show that they can continue to execute for equity markets to rebound. This is still largely an unknown at this point, with expectations that earnings will be revised downward, but hopefully the next several weeks will bring more clarity as earnings season unfolds. This slide unfortunately paints a bit more of a pessimistic picture. As of the end of the day on Monday, the S&P 500 was priced at about 5,400 on a current multiple of 19 times, while earnings expectations for the S&P 500 for 2025 are roughly about 270. Based on the table shown here, at that level and that current valuation, the S&P 500 still looks slightly expensive, which may indicate potential for markets to continue to move lower. If we consider this relative to longer-term average multiples shown here, the narrative gets even a bit more gloomy. As we suggested on the prior slide, earnings growth will have to come through to support markets at this level, as we may continue to see a pressure on the multiple. As we've mentioned on prior webinars as well and indicated today, the U.S. equity market has outperformed the international markets on the back of superior earnings growth leading into this year. But for 2025, given the tariff uncertainty and fears of recession, earnings growth expectations for the U.S. equity market are more on par with international developed markets now, while emerging markets actually show stronger earnings growth estimates for 2025. This may pressure relative performance for U.S. equity markets for the year, while it may suggest a growing opportunity for investors outside of the U.S., which I'm sure David will touch on more. Now to end with risks and opportunities, and we may be a little bit more tilted to the risks for U.S. equities right now. But as we mentioned, while the U.S. equity market may not appear as expensive as it was entering the year, large cap equity valuations do remain above their long-term averages, so earnings growth will be critical to monitor, as we've said, as earnings expectations are likely to still be revised downward. While small cap equity valuations have been attractive relative to their larger cap peers for some time, the recent underperformance has made valuations attractive relative to even their own long-term averages at this point. While this may seem like an opportunity, it is worth noting that the space may continue to come under pressure if discussions of a possible recession persist. More positively, quality may do well and has done well in April. This may present an opportunity for active managers, particularly down the market cap spectrum. Other positives include the potential for policy stimulus through potential tax cuts and deregulation, or any sign of a negotiation on tariffs, as any of these events will likely spur a market rally similar to what we saw on April 9th. But there are no guarantees with this. On the risk side, it is important to remember that timing the market can be extremely difficult, as we've shown on the prior slides, and that market pullbacks are very normal, so staying disciplined through this volatility is key. This is especially true as this volatility will likely persist, as there is still a lot of uncertainty with regard to tariff policy and the impacts of these policies on earnings. Finally, as others have mentioned, stagflation or recession do still remain on the table, as the tariff rate has risen to historically high levels. But to try to end a bit more positively, while the short-term outlook for U.S. equities may be challenged and opportunities are arising elsewhere in the market, we believe the long-term story still remains quite positive.
Thank you, Catherine. The last 2 points are worth repeating in terms of uncertainty and stagflation and recession. I mentioned at the outset of this webinar that the overhang of uncertainty clouds the future and makes it difficult for market participants to really see what awaits in the short term. However, equities have proven to be long-term accretive constituents for portfolios, and we think that will continue to be the case in spite of the likely heightened volatility due to the tariff announcements and consistent tariff revisions. David, over you now for non-U.S. And I know some of the risks and some of the dynamics are the same, but there are other pieces of the non-U.S. equity market which are different than U.S. So I'll let you take it from here.
Yeah, if we start in the first quarter, almost all non-U.S. equity benchmarks produce positive returns. They range from 3% to 8%. EM small cap was the sole index with a negative return in the first quarter. This was largely due to the exposure to Taiwan and India, which had a rough start to 2024. Similar to other assets, similar to U.S. equities, quarter to date through April 14th, non-U.S. equities have sold off, but they are still maintaining their lead over the S&P 500 year to date. Now, I think there are several reasons why non-U.S. equities are outperforming U.S. equities, and we can assign those reasons into two categories. The first are more broad-based, and then the second are more regional specific. So starting with the broad-based reasons, first, currencies this year, unlike many recent years, have not been a detractor for non-U.S. equity investors. In 2024, the U.S. dollar was strong. It was volatile, but strong ending the year, and it detracted 7.5% from the developed market returns and 5.6% from emerging market returns. This year, it's been a different story. EM currencies are up 1%. That's a small amount, but still positive. And developed currencies have added 8.1% to the MSCI EAFE index. So that headwind hasn't been in place in 2024. Now, in our market preview, we did note that it was unlikely to see dollar strength over the medium term. The dollar was trading 2 standard deviations over its 50-year averages. And this year's volatility, policy uncertainty, concerns about slowdown in economic growth, potential cutting of interest rates in the U.S., that has led to a weak U.S. dollar, which has been a positive for non-U.S. equities. The second broad reason that I'll point to is valuation. So over the last couple of years, we've been very intentional not to call non-U.S. equities cheap, but we have said that they are less expensive than U.S. equities. And as many know, headed into the year, many U.S. equity benchmarks were trading in the top decile of its history, meaning that it was expensive. Non-U.S. equities, on the other hand, were trading closer to longer-term averages. And so during a drawdown, all else being equal, there's more room for losses due to multiple contraction when valuations are higher. And so thus far this year, we've seen losses coming more from the expensive U.S. equity market. So those were two broad reasons. You had currencies, you have valuations. Now let's talk about some of the regional specific reasons why non-U.S. equities are outperforming U.S. equities thus far. In the first quarter, if we look at the top 4 performing countries, there are going to be 3 from the European Union, and China is the 4th country. So if we talk about China a little bit, China was up 19% in 2024, and it carried that momentum into the first quarter. It returned 15% in the first 3 months of 2025. Many investors were underweight China given some of the concerns out of that market. And so we did see inflows into that market, kind of catching on to some of the momentum there. You had the government continue with stimulus measures, and all of that has been supportive of Chinese equities to start the year. As we know, April has been a very different story. Month to date through April 14, China is one of the worst performing countries, down about 7.2%, but still because of its very strong first quarter, year-to-date performance has still been positive. Now, U.S.-China trade relations were already challenged, but they've only deteriorated further here in April. Chinese officials have taken a hard stance in terms of negotiations with the United States. They've also stepped in to support their equity markets over the last week or 2 weeks or so. We would expect to see continued volatility on China, and this is a very hard market to forecast or predict, both from an economic perspective, potential impact on tariffs, and things of that sort. Now, similar to China, Europe also had a very strong first quarter. In fact, Europe outperformed the S&P 500 by 14.8%. This is the largest positive performance differential in 25 years, Europe versus the S&P 500. We noted that in our market preview, we noted that 2025 earnings forecasts for the region were expected to be positive after a negative year in 2024. That improved earnings outlook has been supportive for European equities. But what has been even more supportive for European equities is the expected increase in spending around infrastructure as well as defense. One of the early news items in the first quarter was President Trump's withdrawal of support for the Ukraine, and this prompted several EU officials to take action. One of the specific things that occurred is Germany, which has been notorious for having a strict and tight fiscal budget. They committed to easing their government debt limits and increasing spending on infrastructure and defense. And this pushed European aerospace and defense stocks higher throughout the year. Now, despite the pullback, the pullback did impact this industry, but despite that pullback, those stocks are still up 34% year to date. Now, in general, investors have become more optimistic about the medium-term outlook for Europe, given the potential for coordinated fiscal spending, and the influence that can have on economic activity in that region. So there is some optimism there. But with that optimism, there's still concerns on a risk from a global trade perspective. So that's impacting global markets, including Europe as well. And there are many economies throughout the world that are heavily reliant on global trade, even more so than the United States. You have Canada, China, Germany, Japan, Mexico, United Kingdom. All of their trade makes up a bigger percentage of their GDP. So this is a risk for these economies. In addition, if you look at countries that are more susceptible to U.S. trade, Canada and Mexico stand out. More than 70% of their total exports are through the United States, so they are certainly vulnerable there. Tariff news has been a big influence in terms of volatility, both up and down. We expect that to continue here into the near term. Now, given the increased volatility, I thought it'd be helpful to talk about potential increases in short-term tracking error for non-U.S. equity funds. In this table, we list out several benchmarks, non-U.S. equity benchmarks, and a corresponding passively managed fund. Drawing your attention to the top two lines and the column on the far left, you'll see that we show two-day performance for the MSCI EAFE index, which is a developed market benchmark, and a passively managed EAFE mutual fund. The passively managed fund, was down 8.4% between April 3rd and April 4th, and the index fund was down 5.8%. That's a 2.6% difference, which is a very large difference for 2 days of activity. Now, the reason for this difference is fair value pricing. So we remember that non-U.S. equity markets have different closing times than U.S. markets. For example, the London Stock Exchange's closes at 10:30 a.m. Central U.S. time. Benchmark providers like MSCI use the closing price from the local exchanges to calculate their index return on that day. Mutual funds are traded at the end of the U.S. closing prices, so they will incorporate any new information or pricing movements that happen after the local exchange closes and once the U.S. market closes. So during periods of large intraday movements or if big news information comes out, that can lead to large tracking error. Now, these price discrepancies eventually even out. The large market movement that occurred will be captured in the local markets the following day. So this does even out over time. But this is a phenomenon that I think non-U.S. equity investors should be aware of, especially if they're reviewing short-term performance during very volatile time periods like we're experiencing currently. So let's wrap things up with the opportunities and risk on non-U.S. equities. We talked about Europe and the probability for collaboration, increased fiscal spending, and how that can potentially impact the economy within that region. Earnings growth, outlook has been positive, but we'll see what happens with tariffs and how that takes shape and look at what guidance the companies will be giving. So while that's positive, we have to watch it to see if there's any change there. And then valuations, it's less expensive than U.S. equity markets, which all else being equal can provide a little bit of protection to the downside. Risk are out there. We've talked about the risk in all the various sections, trade, uncertainty around economic policy, Trump policy as well. And then China's got a very hard forecast to look at from an economic perspective. The consumer's still challenged, and then from a trade relationship perspective with the United States.
Thanks, David. And what we've shared on previous webinars is that non-U.S. equities versus U.S. equities, you tend to see sustained periods. I'm talking 10 plus years of outperformance of one versus the other. And from a valuation basis, non-U.S. has been poised to assume the lead for a while now, but earnings has always been disappointing, and there's always a catalyst that needs to be present to jumpstart that flip. So maybe this is it, something that bears watching, and certainly a couple months of outperformance doesn't warrant a 10-year period, but again, a pattern worth monitoring in the coming quarters. All right, let's move now out of traditional over to alternatives. And Evan, you kind of sit in the middle here of traditional asset classes and alternative asset classes. Hedge funds really play in every space, and I know that there's been some interesting performance dynamics that you've seen, as well as some emerging opportunities. So take us through what you're seeing.
Yeah, absolutely. Thank you, Greg. As you can see here, we always start this section with the table of historical returns for hedge funds. I think given the market volatility that we've discussed in recent weeks, these 1Q numbers maybe aren't the most relevant. Unfortunately, pretty much all of these indices price on a monthly basis, so we don't have any April data just yet. But there are certain things that we can glean from these numbers, as well as some others that we'll look at here in just a minute. So the S&P 500, which not on this list here, but Catherine discussed, was down about 4% in 1Q and about 6% in March. But you'll notice that each hedge fund index on this list outperformed the S&P on both a month and year-to-date basis, so that's positive. And then some spaces like relative value, convertible arbitrage, global macro, et cetera, were even positive in the first quarter. So that's kind of the backward-looking information. Now we can spend some time looking at some other data points that might give us insights into how hedge funds might perform going forward amid these higher levels of volatility. So here we can see the VIX futures curve as of earlier this week compared to where it was at the end of February. So spot VIX was actually above 50 last week and still sits at about 30, which is, as you can see, well above its long-term average. Most forecasters that you'll read and listen to believe that volatility will remain elevated relative to history as these trade negotiations progress. So we decided to put together some analysis related to how hedge funds perform when the VIX is higher than normal. And here it is. So this is data going back to 1990 when these HFRI hedge fund indices were incepted. And what we can see is that all of the major hedge fund indices that we have listed here at the top of the chart outperform the S&P 500 pretty much across the board when the VIX is a standard deviation or more above its long-term averages. So think of periods like the tech bubble, global financial crisis, COVID, et cetera. The idea here is that hedge funds are much less directional than the market, so they're not capturing the full extent of these drawdowns. But they can also be active during market dislocations, which usually present interesting alpha opportunities. And you can see, too, it's sort of the right-hand side of this chart here that we've seen the VIX shoot up above 2 standard deviations, higher than its average over the last couple of weeks. So if history is any indication here, we should see solid relative performance trends from hedge funds in the coming months. And there's a similar story on this slide as well, except here we're looking specifically at option selling strategies. So we decided to dedicate a full page to these types of strategies, given the extent to which we kind of utilize them across our client base. So what we're looking at here is performance of the put right index in green, which is short S&P 500 put options, and then a pool of treasuries. The combo index in blue, which is short put and call options, as well as the treasury pool. and then the S&P 500 in gray. And then the 5 kind of sections that you can see on the chart are based on the S&P 500 return. So the far left is the average 1-year rolling return for each of the indexes that are listed when the S&P 500 is returning negative 5% or lower, and then so on as you move across the page. And what we can see here is that option selling strategy, these strategies tend to outperform the S&P 500 in pretty much all markets, except for those that are trending much higher. And you can really see those relative performance benefits kick in when we see significant equity market pullbacks. And the reason for that, I guess there are a couple of reasons. So number one, the treasury pools that these strategies use to collateralize the options with, they create a sort of a performance buffer on the way down. And then once volatility kicks higher, the strategies, the managers can then roll their options positions forward at higher levels of premium. So this year, as of, I believe, yesterday, the put-right index is down about 5%. The combo index is about 5.5% down, and the S&P 500 is down about 7 or 8%. So we are seeing that solid downside protection from these types of strategies, as we would expect. And they should continue to exhibit solid relative performance if volatility continues. So I mentioned that we don't yet have April performance for most hedge fund indices, including the equity hedge benchmark. But there are some ways of kind of looking at how long-short equity strategies might be performing so far in April. So here we have a scatter plot that shows 5 years of daily returns for a basket of popular hedge fund long positions on the x-axis, and then a basket of popular hedge fund short positions on the y-axis. And so for the entire data set, the average spread, the average performance spread between these two baskets is around 25 basis points of long outperformance, which might not seem like much, but that's the daily average. So if you add that up over time, that certainly compounds. But what's interesting to look at is that if we take the 5 most volatile days in April, which you can see highlighted in red, we get a spread of about 110 basis points. So in other words, popular hedge fund longs have outperformed popular hedge fund shorts by more than a percentage point amid these sort of wild market swings. And that's certainly good news. And while we certainly have a ways to go in a month that feels like it's never going to end, this trend should lead to solid April performance for long-short equity hedge fund strategies. So going into the year, a popular trade across hedge funds was treasuries over interest rate swaps, which are usually exchanges of a fixed rate for a floating rate. So when a swap, the side that receives the fixed rate benefits when rates fall, and the position essentially acts as a way for an entity like a bank to add duration without holding treasuries on its balance sheet. But that trade has actually worked against hedge funds in recent weeks due to the new tariff rollout. So banks now are selling treasuries to raise cash due to a more uncertain economic outlook. And at the same time, they're adding swap contracts to maintain that interest rate exposure. And you're also seeing treasury supply expectations going up, thanks to questions on how the U.S. government might offset any potential future tax cuts that are coming down the line from a budget perspective. And the result of this is that swaps, again, have significantly outperformed treasuries, leading to a record low, at least as of a couple days ago, record low spread between swap rates and treasury yields, which we can see here on the slide. Going forward, I think it's fair to expect these wider spreads will persist into the future until we see some of the dislocations in the treasury market kind of get resolved. And then, so to wrap things up on the risks and opportunities, so the ongoing uncertainty related to tariffs, certainly a risk that folks have highlighted ad nauseum on this webinar today. Greg, you mentioned earlier today that leverage giveth and leverage taketh away. That's never more true than in periods of high volatility, and something we certainly need to keep a close eye on in the hedge fund space specifically. We could also see a pause in deal making and other corporate actions as companies sort of work to assess the impacts of new global trade restrictions on their bottom lines and wait for more clarity there. That could cause issues for strategies like merger arb and event-driven in the hedge fund space. But again, to reiterate from a couple slides ago, I do think the current opportunity set is positive for hedge funds in general, at least on a relative basis, maybe relative to equities or relative to where the opportunity set had been in recent years. For instance, I mentioned that VRP or option selling strategies are able to extract higher option premiums now, given the fact that volatility is much higher. Global macro managers, additionally, should be able to capitalize on dislocations caused by these sort of wild market gyrations, and they can do it across, a bunch of different asset classes, equities, rates, currencies, commodities, et cetera. And then if we do get a new credit cycle as a result of an economic downturn or even just a slowdown, that could benefit funds with a focus on distressed investing. So I would say it's certainly an interesting time for the hedge fund space across a variety of different strategy types. And with that, I will turn it back over to you, Greg.
Evan, thanks. And it'll be insightful to see which strategies can effectively protect and perhaps even add some upside if we see ongoing market volatility and equity markets going sideways, if not going down over the course of the year. So that's hedge funds. And then the next two asset classes, real estate and infrastructure, we think can really help buoy portfolios in times of a recession or even worse, stagflation. So Dennis, we have real estate, we have infrastructure. The caveat here, of course, is that data is lagged for these asset classes, but nonetheless, it's worth talking about trends you're seeing as well as what you're going to be watching for the rest of 2025.
Absolutely. So for real assets, I'll start with real estate. For performance, as Greg said, the performance is reported on a lagged basis. For the fourth quarter of last year, the NFI Odyssey Index achieved a total gross return of 1.2%, marking a second positive return in the past 8 quarters. This was driven by 1% gross income and 0.2% appreciation. For the preliminary report that we received for the fourth quarter this year, it shows 1% gross return, and this will be a third positive quarter for core real estate after the recent down cycle. You can see this. You can see on this chart here. There's a performance recovery in both NFI on the property level and NFI on the fund level indices. This could be a signal that the market is stabilizing and we may enter a new real estate cycle, especially as valuation adjusts and capital slowly return to the space. Building on that momentum, we also see early signs of pricing recovery. After a 22% drop from the 22 peak, commercial property value has started to rise modestly in 24. While the rebound is still pretty early, this trend suggests that we may have found the bottom, especially as price recovery improves and the transaction volume slowly return. In addition to that, we also see clear signs of activity picking up. Specifically, U.S. commercial real estate investment volume jumped to $121 billion in fourth quarter of last year. That's up 30% year over year and 24% quarter over quarter. Most of that is still driven by single asset deals, as you can see here, but we start to see more portfolio and entity level transactions, which tend to follow as confident return to the market. In addition to more transactions, there are also signs of normalization in the debt markets. CMBS issuance totaled $109 billion in 24 compared to just $40 billion in 23. That's nearly a threefold increase. This marks a significant recovery after a very quiet year in 23, when both borrowers and lenders were hesitant to transact. This rebound reflects two important shifts. Greater confidence in stabilized valuation, which gives lenders more comfort to underwrite. Second, growing investor demand for real estate debt, particularly as spread tighten and sentiment improves. To wrap up, we see a mix of compelling opportunities and ongoing risks in today's real estate landscape. On the opportunity side, market dislocations are creating attractive entry points, especially in non-core and distressed assets. We're also seeing gradual improvement in deal flow and capital availability. And alternative sectors like data centers, SFRs, and healthcare assets continue to benefit from strong secular demand. On the risk side, office remains as the weak spot. Rising costs from tariff and labor shortages are also challenging development, and the high 10-year Treasury yield could weigh on valuation and financing. Moving on to infrastructure for the performance part, in the third quarter of last year, we see a 3.4% quarterly return for private infrastructure, with a solid 10.9% return over 1 year and consistent performance over longer periods. Infrastructure continued to stand out for its consistent inflation-adjusted income. This chart highlights how the asset class has historically offered higher average yield compared to traditional equities. Long-term contracted cash flows from essential services like utility, transportation, and digital infrastructure support very attractive income and downside protection as we enter a more uncertain macro environment. One of the major structural tailwinds for infrastructure right now is the shift towards deglobalization. We're seeing a surge in U.S. manufacturing construction spending. 24 alone achieved nearly $220 billion, almost doubling over the last 2 years. Manufacturing now make up around 19% of the total non-residential construction, the highest in over a decade. So while infrastructure already offers stable income, these secular growth drivers also provide potential for long-term capital appreciation. Lastly, I want to point out energy infrastructure continued to be a powerful long-term theme. We're facing a massive capital need between $120 to $190 trillion by 2050, depending on the level of ambitions we're talking about around energy transition. That's about $4 to $7 trillion per year, and a significant portion will be directed towards building and upgrading energy infrastructure. At the same time, power demand in the U.S. is rising steadily, especially with the growth of digital assets. The right side of the chart, as you can see here, shows power demand growth now tracking closer to, or in some cases, outpacing GDP growth. So infrastructure investing isn't just about stability, it's increasing about tapping into structural growth, especially in energy and renewables. To close on infrastructure here, on the opportunity side, infrastructure remains as a reliable inflation hedging and income generating asset class. With power demand surges from digital development, there's a growing need for investment in grid, energy storage, and transmission. On the risk side, GDP-linked assets like ports or toll roads can be more volatile in a slowdown. And apparently not all infrastructure assets are created equal. So asset quality, operational execution, and access to deal flow remain very critical to long-term success. With that, back to you, Greg.
Thanks, Dennis. And we put out our client letter this morning we titled it Bracing for Inflation. And we identified real estate infrastructure as the best shelters from the ill effects of stagflation. And it's not just stagflation in which real estate infrastructure are beneficial to portfolios. It's always about the income and the diversifying effects of both these asset classes. So we think the demand for these asset classes remains in place for institutional portfolios. Let's move now to the private markets portion of this afternoon's webinar. And Haley, we'll let you kick it off with private equity.
So just like infrastructure, private equity performance is reported on the lag basis. So this is as of Q3, and obviously a lot has changed since then. So we're expecting flat to slightly positive performance for private equity across the board as we look to Q4 and Q1 of this year, or Q4 of last year and Q1 of this year. When you look at manager performance, it's really going to vary by manager, and it's going to vary by which vintage year you have exposure to. We think that overall prioritizing managers who invest in companies that have reoccurring revenue and minimal leverage will best position your portfolio for this environment. Long term, when the public market performance of this year is factored into private equity performance, we expect private equity to continue to outperform public markets. Deployment picked up in 2024, and that factored into the first quarter of 2025. As we look towards the rest of the year, we're hearing from managers that a lot of deals are either being put on pause or reevaluated due to the impacts of tariffs. So we're expecting deal volume to decrease going forward throughout this year. The story is similar for exits, so this is also expected to slow this year, and this is mainly due to the IPO market isn't going to be opening up anytime soon. So this will have a trickle-down effect throughout all private equity exit activity. Now, as a reminder, when there's a pullback in public market performance, private equity typically does not experience as severe of a pullback and typically recovers at a faster rate if we look at past downturns. Now, on a positive note, market dislocation typically benefits secondary funds. There can be opportunities for secondary managers to take advantage of the current environment. So at the end of last year, there was a supply and demand imbalance, so meaning that there was more supply for secondary transactions than there was capital to support the supply. So we think there will be an opportunity potentially in secondaries throughout this year. Now, I touched on some of the risk and opportunities already, but I'll summarize a few. First being, we'll expect limited volatility of returns for private equity, and that could be good opportunities for the secondary market as well. In terms of risk, the public market performance is going to impact fundraising for GPs, so that's expected to be affected. Also, we don't know the full impacts of tariffs, so we're not going to really know the full effect it's going to have on private markets performance.
Given the illiquid nature of private equity, certainly the manifestation of tariffs and the underlying investments within private equity portfolios will take a while to kind of show themselves, but certainly another dynamic that bears watching as the markets play out here. And Chad, let's move it over to you now for private credit. Private equity and private credit are obviously tied very carefully in some ways, but in other ways, private credit is of course an independent asset class as well. So take us through what you're seeing.
Yeah, thanks, Greg. Not to sound like a broken record once again, but returns here are lagged in private markets. The data here is through the end of the calendar year. 2024 capped off a really strong year for private credit broadly. Investors benefited from elevated all-in yields and limited and below average credit losses. Direct lending, which again, as a reminder, is the largest part of private credit, delivered a return of 11.3% for the year. That outperformed leveraged loans by about 220 basis points and high yield by over 3% as liquid alternative comparisons. Now, that said, given the volatility investors have experienced so far this year, 2024 does feel like a bit of a distant past. So let's look at some more recent data to bring us forward to 2025. While we don't have official returns yet for private credit, most of the volatility experienced in liquid markets really didn't occur until we entered April. So I wouldn't expect to see any impact to private credit returns when Q1 returns are posted in May. However, given the ongoing uncertainty we're seeing play out in real time, I think it's helpful to look at these liquid proxies just to understand how volatility is impacting them and what that may mean for private markets. Now, to do that, we can look at high yield, we can look at leveraged loans and listed BDCs, which are all shown here on the chart. Leveraged loans and high yield, they're down only slightly so far this year. Most of that pullback coming from spread widening after Trump initially announced tariffs in early April. Interestingly, though, BDCs reacted pretty violently, down almost 14% at one point before recovering some of the losses when tariffs were paused temporarily. Now, while the volatility is notable, I would caution extrapolating that into private markets. BDCs trade with high equity beta, they're heavily influenced by retail flows, and there's a wide array of quality on the names that are included in the BDC index. Now, that said, if we continue to see volatility, if we see weakening in the economy, this will eventually start to bleed into private credit from more of a credit standpoint. But for now, I think the relative impact is fairly muted, and especially in Q1, I don't think you'll see any of it at all. Now, thinking about the downside, I think it is a helpful reminder to look back at prior drawdowns in equity markets to see how private credit has fared. This here shows the last three equity drawdowns: the global financial crisis, COVID-19 pandemic, and the volatility from rate hikes in the regional banking crisis 2022. What you'll find is in each of these periods, private credit has held up pretty well. It's been really resilient. That's the blue bar on the left of each of these periods. The key takeaway here, generally, private credit is driven by contractual income. There's key structural protections in place. And I continue to believe private credit will be a ballast regardless of what happens in more liquid markets throughout 2025. Now, we talked a lot about tariffs. This is changing by the day. It's a very fluid situation, but we can start to assess what the potential impact is on different parts of private credit and specifically different industry segments. The weights here shown are from the Cliffwater Direct Lending Index, and you can see a relative assessment of what tariff sensitivities might look like for each sector. Now, a significant amount of our exposure is focused on U.S.-based borrowers that operate only in the U.S., so the first order impact of tariffs should be largely de minimis for those exposures. There are a few industries that certainly have more potential impact from global supply chains, namely consumer and retail, industrials, materials, things like that. But that in aggregate represents less than 25% of the index, and many of our managers have limited exposures to those sectors anyways. That being said, this is certainly evolving. We don't know what the ultimate tariff policy will look like. And also, it's a good reminder that many of these businesses have already been moving their supply chains out of China into other parts of Asia. So they very well could be somewhat limited in terms of their impact, depending on what the actual tariff policy looks like going forward. Now, from a near-term perspective, we have seen a significant pause in activity, both from an M&A standpoint in private equity markets, but also we've seen significant declines of refinancing activity of current loans as borrowers have pulled back short-term. What's shown here is leveraged loan volumes. You can see coming into the year, January is a really strong month for loan issuance, but that has fallen off a cliff in February and March and continues to be relatively light here in April. Now, the positive is that in most periods of uncertainty like this, we saw this in 2022, liquid syndicated markets tend to shutter. Private credit, given their flexibility and certainty of execution, tends to step in, ends up actually being a fairly good environment for private credit to deploy into. The other positive is in that environment, we would expect loan spreads to widen out for new issues. So that's again positive for private credit when they're in a position of strength and dry powder to react and deploy into it. Flipping gears a little bit, we can look at overall credit health. And there's a number of metrics we can look at to see if there's building signs of stress. Frank mentioned defaults being below average in liquid credit markets. I would say the same holds true for private credit. One reason for that is the overall health of the borrowers. What you see here is interest coverage ratios. So this is the margin of safety borrowers have to meet their interest payments on their debt. Now, given the significant rise in interest rates in 2022, that certainly pressured borrowers. We saw interest coverage ratios come down from 3 times to about 1.6 times. But those ratios have now stabilized and actually gone in the opposite direction more recently with cuts in rates in the second half of 2024. Now, any further rate cuts as a result of the macro impacts of what's going on globally would also provide additional relief to borrowers. So from a credit standpoint, things are still relatively good and additional relief could be on the horizon. Now, I'll just summarize and wrap up with a few opportunities and risks here. I'll start with interest rates. It's a little bit of a double-edged sword for private credit. On the one hand, if the Fed cuts rates, that'll provide relief to borrowers, as I just mentioned. But on the other hand, that cuts the current yield investors have enjoyed for the better part of the last few years. The silver lining to that is this could partially be offset by wider spreads, especially if the syndicated markets really do shutter like they did in 2022. And we've started to see a little bit of that, some indications of 25 basis point widening across the various parts of private credit. And I think there's more to come on that depending on how this plays out. Again, in this environment, I think private credit's well positioned from a position of strength, the ability to tap their speed and execution certainty to help borrowers get deals done, move forward, things like that. That's all really positive. Again, we favor the core and lower middle markets, which are less reliant on global supply chains, largely insulated from tariffs, or at least from a first order perspective. But from a risk standpoint, there are some industries that will have exposure. So we were mindful of that. We're monitoring each portfolio carefully to make sure that those risks are identified and addressed accordingly. And then there's additional uncertainty from a macro perspective. So from an M&A environment, slower deployment, generally that'll flow through to private credit in various ways. And the last thing, just a reminder that private credit should provide a ballast here. Again, heavily income-oriented, performing credit, and we're not seeing rising risks of credit deterioration in the portfolios today.
Thanks, Chad, and certainly a lot of attributes of private credit, which we think could be helpful across all environments, but particularly where we find ourselves today. We're at the top of the hour. I promised everyone we would limit this to 60 minutes. I want to thank all of our analysts. They put a ton of work into not only this webinar, but all the updates you've been receiving. They've been posting to our website, putting a lot of long hours in to get all the information and write-ups put together. So for all the analysts, thank you very much. And for those of you who joined us this afternoon, thank you for your time. We hope this has been helpful. We hope it's provided all of you a little bit of insight, intuition into not only what has happened, but where we could go from here. The reality is there's still a lot of uncertainty out there. None of us know with any certainty, but we are watching a lot of the key metrics that we shared with you this afternoon as primary indicators of what could happen with the markets. Thank you again. We hope this has been useful. Have a great rest of your day.